Choosing a passive investment strategy might seem the safest long-term bet, but it brings inherent risk. Excessive diversification has also proven to be an inadequate tool for managing risk. So where's the middle ground? Scott Clemons shares his insights. So first, are investors more or less at risk since the global financial crisis?
Kamuta, I think they are in the simple sense that valuation is the best measure of risk, and valuations of equity markets, either here in the States where I am or in Europe or abroad, have risen dramatically since the worst days of the global financial crisis. So the risks that remain in the market remain without the margin of safety that lower valuations might bring. So yes, I think this is a riskier investment environment.
Very interesting. Now, with the global aging population increasing, frankly, in its demographic, are you seeing more turning to passive investments such as index funds?
The real shift that we've seen in asset allocation isn't so much between active and passive because of demographics, but it's from fixed income and into equities. And that's a reflection largely of the lack of yield available in global fixed income. Traditional asset allocation would have an investor raise his or her allocation to the safety of fixed income as they age, but that safety comes without any yield. So investors have really had no choice but to remain in equities versus fixed income. And that's the shift that we've seen demographically as well as reflecting the global nature of interest rates in this market.
So what is the inherent risk that lies within these indices?
Well, Kamuta, there's no such thing as an investment without risk. And I worry that sometimes investors confuse the label passive with a connotation of risk-free, and it's not. For example, there is an investment strategy baked into the fundamental approach of any index fund. Most index funds are based on market capitalization, so the larger a company is, the number of shares outstanding times the price of those shares, the more of it an index fund has to buy. It's the essence of a price momentum strategy. When markets are going up, price momentum is great. It's a strategy that works. But when markets turn down a price momentum approach, such as that embodied with an index fund, can be quite painful, as we learned in 2008, 2009, the global financial crisis, and really in any bear market in equities, we see price momentum on the downside. That's all an index fund provides.
So if the solution is to be a more active investor who insists on transparency in the investment process, how does one go about achieving that ideal?
I'm afraid it takes some work. The beauty of passive investing is it's a thoughtless, if you will, approach to owning equities or to owning any asset class. And by active approach, don't confuse active approach with a frequency of trading or a high trading type approach. It simply means understanding what the underlying investment strategy is in whatever fund you're using and comparing it to the alternatives. So if on one hand an index approach is largely a price momentum strategy, investors should compare that to other strategies such as a value-based strategy or a fundamental-based strategy, and then decide which of the options on offer are best aligned to supporting their goals.
Now, when it comes then to passing wealth to future generations, should one's investment portfolio goals equally shift?
Absolutely. And if you look at the sheer scale of wealth that's likely to be transitioned over the next generation, largely because of the demographic trends that you've identified, investors are already confronted with the opportunity and the challenge of investing not only for their own lifetimes, but for the lifetimes of their children, their grandchildren as well, planning for philanthropic goals, etc. So I think the old traditional approach of making sure that you have enough money to prepare for retirement and for healthcare in your later years, as wealth levels rise, begins to encompass the broader goals of the next generation as well. And investors are well advised to think about that as they create their asset allocation.
Finally, how can advisors to wealthy families help with that transition?
Well, if you think about the wealth transition that families go through, most families only ever experience that maybe twice at most. Once when the current generation inherits the wealth from their parents, and then again when they pass it on to their children. So they have two data points of experience to draw on. Advisors, on the other hand, accountants, financial advisors, investment advisors, have a whole wealth, a breadth of information and experience about how those transitions take place. Simply by asking the question of your advisory team, you can uncover paths to failure, paths to success. You can learn vicariously from the experience of others. It's something that both investors as well as their advisors should spend more time and attention on.